Welcome back to the Deep Dive, the place where we cut through the financial fog and give you the essential, digestible knowledge you need. Today, we're undertaking a pretty crucial dive into the operational and financial heart of, well, one of India's energy giants, Indian Oil Corporation Ltd, IOC. We're specifically unpacking their recent unaudited results. This is for Q2 and a half year, H1, covering April 1 to September 30, 2025. And this isn't just, a standard report. These numbers show a financial performance that's just, well, spectacular compared to last year. Raises immediate questions.
That's absolutely right. Yeah, the reports, they were approved by the board just recently, October 27, 2025. And they detail a stunning turnaround. When we synthesize the standalone operational figures with the consolidated financial statements, the story is consistent. Massive, kind of unprecedented profitability growth in this first half of fiscal 25-26. So our mission really is to find the smoking gun. What specific factor, or maybe combination of factors, allowed IOC to generate such, well, extraordinary cash flows?
Okay, let's get straight into the scale then, because the figures are genuinely staggering, particularly when you put them into context. Looking at the consolidated H1 results first, the total revenue from operations came in at Rs 4,028,296.13 crore.
Right.
Now, for listeners maybe unfamiliar with the Indian system, a crore is 10 million. So we're talking about figures well north of 4 lakh crore rupees. That's, what, roughly over $51 billion USD in just half-year revenue?
It's a huge top line.
Yeah, a strong revenue base, definitely. But the real story, I think, is how much of that revenue they actually kept.
Exactly. The leverage and efficiency story. That's where the fireworks start. Look at the profit before tax, PBT. For H1 FY 2025-26, the PBT reached Rs 19,854.19 crore.
19,800 crore. Okay.
Now compare that. Just compare it to the same period as last year, H1 FY 2024. The PBT then was only Rs 4,252.33 crore.
Oh.
That isn't just growth. That's like a fourfold increase in pre-tax profit in 12 months.
A fourfold increase.
Yeah. This is the kind of leap that suggests something fundamental shifted, and the economics of the industry, not just like marginal efficiency gains.
And that phenomenal PBT, well, it feeds directly into the bottom line, right?
Yeah.
The net profit for the period attributable to the parent, it soared to Rs 14,631.26 crore for this half year.
14,600 crore.
Again, for context, that figure was, what, a comparatively thin Rs 3,358.91 crore in H1 2024. Just incredible.
And when we look at the core measure for shareholders, earnings per share, EPS support, the impact is crystal clear. EPS jumped from Rs 2.44 a year ago to a very, very robust Rs 10.62 per share this period.
Okay, so we've established the money's absolutely there. Huge profits. The next question for us and for you listening is the efficiency metric. How well are they actually converting that massive revenue into profit?
Right, and the consolidated net profit margin tells that story perfectly. They went from a really slim margin, just 0.78% in H1 FY 2024.
Less than 1%.
Yeah, tiny. To a healthy 3.50% in H1 FY 2025-26.
3.5%. That's a substantial expansion.
It really is. A jump of that scale, it demands a deeper look at the operational engine room. It usually means either their input costs, like crude oil, dropped significantly, or the price they could charge for their refined products went up dramatically, widening that critical spread.
Okay, let's drill down into operations then. Did they just sell a lot more product? Is it just volume?
Oh.
Looking at the volumes, their standalone refineries throughput for H1 was 36.292 million metric tons, MMT. That's up, but only marginally from 34.906 MMT previously.
A small increase.
And pipeline throughput also nudged up slightly, hitting 50.343 MMT.
Right, so the volume growth is marginal, which really confirms that this entire story hinges on margin. That operational increase, it's just not big enough to justify a fourfold profit jump. The focus has to be almost entirely on the gross refining margin, or GRM.
Okay, define GRM for us quickly again, because it sounds like it's the absolute key metric here.
It really is. GRM, gross refining margin. It's essentially the difference between the cost of the crude oil coming into the refinery and the value of the finished products like gasoline, diesel, jet fuel going out. It's basically the profit they make just by turning a barrel of crude oil into refined products before other corporate costs.
Got it. So what did that critical metric look like this half year?
Okay, so the average GRM on a standalone basis for H1 FY 2025-26 was $6.32 per barrel.
$6.32.
Yeah, and that is a huge step up from the $4.08 per barrel they reported in H1 FY 2024.
$4 to over $6.
Exactly. This increase basically means the market spread, the difference between crude and product prices, was fantastically generous for them.
That's a significant boost, definitely. But I know the reports often include a technical adjustment. You mentioned a core GRM. What's that, and where did it land?
Ah, yes, the core GRM. This is where it gets really interesting, actually. It shows the underlying strength of the market conditions. The core GRM, sometimes called the current price GRM, basically strips out the one-off effects of inventory gains or losses, changes in the value of oil they already held.
Right.
That core figure stood even higher at $7.89 per barrel.
Wow. Nearly $8 a barrel.
Almost $8 a barrel, yeah.
So tell us the why. What kinds of external factors could drive that GRM from around $4 to almost $8 in just a year? Was this just like market luck? Good timing?
Well, the sources don't give us the specific analysis, but generally when we see a core margin jump like this, it suggests a couple of major factors playing out globally. First, there was likely really robust demand for specific refined products. Could be jet fuel, could be middle distillates like diesel, particularly maybe in the Asian market where IOC operates predominantly.
Okay, strong demand.
And second, it often implies a temporary tightness in global refining capacity, maybe due to seasonal maintenance shutdowns elsewhere or unexpected outages, something that reduced supply. This allowed refiners like IOC, who were running well, to command premium pricing for their output. They capitalized spectacularly on what seems like a very favorable structural gap in the market.
That context is vital. Yeah, it shifts the narrative a bit. It's not just about pure internal efficiency, but also about excellent execution during a highly favorable global market window.
Precisely.
And on the sales front, it looks like they successfully pushed that product out. Combined H1 sales hit 50.59 MMT. Domestic sales making up the vast bulk of that at 47.824 MMT.
The name of the volume.
Okay, let's analyze which segment of the business really reaped the rewards of that strong GRM. We look at the consolidated profit before tax for the different segments. And yeah, one clear winner emerges.
Absolutely stands out.
The petroleum product segment. It delivered an astounding RS, 21,420.13 crore in PBT. It is unequivocally the financial engine that drove this record half year.
21,400 crore. And that just emphasizes how crucial that refining margin environment was. Because when you look at the other businesses, the non-core ones,
Yeah.
the results are far more modest, almost negligible in comparison, actually. The petrochemical segment only contributed, RS 167.4 crore, and the gas segment contributed RS 293.90 crore.
Okay, so why are those figures so comparatively weak then? What does that tell us?
Well, it strongly suggests that while crude processing and distribution were enjoying these stellar margins, the petrochemical and gas markets were under far greater pricing pressure. Petrochemicals, for instance, they're highly sensitive to global commodity cycles, softening demand, maybe oversupply issues.
Right.
The fact that their profit contribution is so tiny just reinforces the idea that the core refining business completely carried the company during this period. Without that, $7.89 core GRM, this entire financial result would look drastically different.
Makes sense.
And if we connect this to the bigger picture, this operational success, it wasn't just about showing big profits for the period. It was also about strategically using that cash flow to sort of fortify the balance sheet. We see crucial improvements in key consolidated financial ratios, which is a fantastic sign of, longer-term health.
Okay, tell us about those financial health markers. What improved?
First, the debt-equity ratio. That's a key measure of leveraging how much debt they use compared to equity. It improved substantially. It came down to 0.68 from 0.83 previously.
Lower's better there, right?
Yeah.
Less debt reliance.
Exactly. A lower ratio means the company is less reliant on debt financing relative to shareholder equity. It provides a much more stable foundation.
Good. What else?
Even more impressive, I think, is the inter-service coverage ratio. This measures the company's ability to easily pay the interest obligations on its existing debt. It increased dramatically to 6.56. That's up from 3.35 in the prior period.
Wow, nearly doubled.
Yeah. It signals really robust financial capacity and minimal risk regarding their existing debt management. It's exactly what investors want to see when a company hits a period of peak profitability like this. Use the cash well.
Makes sense. And speaking of debt, the report confirms the outstanding amount. Let's see. RS 20,290.2 over crore in listed non-convertible unsecured debentures. It says that's being used appropriately.
Yes, used for refinancing, capital expenditure, general corporate purposes. Crucially, it notes no deviation or variation in the use of those funds. That consistency provides confidence to the debt markets.
Okay, good financial housekeeping alongside the big profits. But we can't really analyze IOC without acknowledging the reality of operating under government policy, can we? Especially when it comes to things like domestic LPG, cooking gas. That often requires the company to act as a mechanism for consumer subsidies, which leads to under-recoveries.
This is the massive balancing act that really defines the Indian energy sector, especially for the state-owned players. Under recovery happens when the government sets a price for a product, like domestic LPG cylinders, that is actually less than the real cost the company incurs to procure and supply it.
So the company loses money on every cylinder sold at the regulated price.
Essentially, yes. And this creates a massive exposure, a kind of receivable from the government that builds up on the company's books.
And what does that exposure look like right now? We saw a pretty staggering figure in the source material.
We did indeed. The reports explicitly state that as of September 30th, 2025, the cumulative net negative buffer, which is essentially the company's accumulated claim or debt from selling subsidized LPG below cost, stood at a monumental RFUPS 25,768.700 crore.
25,700 crore. Just, wow. That is a colossal number.
It is. It's a liability, or perhaps more accurately, an expected receivable, hanging over the balance sheet that actually dwarfs even the record net profit they just achieved this half.
That's incredible. It's more than the entire half-year profit. So, okay, how does the government plan to address that liability and, keep the company whole? Does the report say?
Yes, it does. The Ministry of Petroleum and Natural Gas, MOPNG, stepped in with a structured solution. This was communicated in October 2025, after the reporting period ended, but relevant for understanding the situation. IOC is set to receive compensation totaling Rs 14,486 crore.
Okay, 14,400 crore.
Right. This amount is intended to offset past under-recoveries, specifically those incurred up to March 31st, 2025, and also those likely to be incurred over the rest of the current fiscal year up to March 2026.
So it covers past and some future expected losses.
Yeah.
How do they get the money? Is it a lump sum?
No, and this is the crucial accounting detail. It is not a single lump sum payment. It will be dispersed in 12 equal monthly installments, starting from November 2025.
12 installments.
And critically, from an accounting perspective, IOC will only recognize that revenue, that is, book it as income on their P&L when the accrual becomes receivable each month.
So they can't book the whole 14,000 crore up front.
Correct. It means the benefit will be stretched out over a full year. It smooths the impact on their quarterly results, but it also really highlights their sort of structured reliance on these government payouts to manage the subsidy burden.
Got it. Okay, so the LPG subsidy is one major external factor. But beyond that, the report also flagged an ongoing disagreement, didn't it, over supplies to the defense sector?
Well, yes. Another contingency item noted, the Principal Controller of Defense Accounts, PCDA, and the Indian Air Force deducted sums. Let's see, Rs 621.25 crore and Rs 68.78 crore, respectively. So around 690 crore total.
Okay. Why?
This deduction relates to a dispute over a price differential on fuel supplies made quite a while back, between January 2022 and March 2023. The report states this issue is still under deliberation and is actively being contested by IOC and also through the MOPNG. It just serves as a reminder that even in the cleanest financial quarter, there are always these contingent liabilities and bits of operational friction to deal with.
Right. Always something. Okay, so let's try and tie this all together for you, the listener. IOC delivered absolutely spectacular H1 profits, primarily driven by a highly favorable global market that resulted in that staggering average gross refining margin of $6.32 per barrel.
And the core GRM hitting nearly $7.89 per barrel.
Exactly. They executed well during this market window, clearly. And they used the cash generated to boost key financial health ratios, like the interest service coverage ratio, which is great to see.
Absolutely. The financial leverage has come down. The efficiency story is a major success for this period. However, the reports, while celebrating the profit, also reveal that tightrope walk inherent in their operation, especially with the subsidies, while the Rs 14,486 crore compensation is coming.
Which is good news.
It is good news, but the cumulative net negative buffer on LPG, that underlying liability or receivable, it remains incredibly high at over Rs 25,700 crore.
Still a massive number, even after the compensation is factored in over time.
It is, and this raises, I think, an important final question for you to consider. The company's spectacular short-term success was clearly built, at least in large part, on a temporary, high-margin global environment for refining. So given the massive scale of that structural liability represented by the negative buffer from subsidies, how significant is IRC's dependency on both continued global margin stability and the structured, reliable government payouts for its strong financial future?
Hmm.
And maybe how much volatility does that dual dependency introduce into the coming quarters, especially once those 12 compensation installments run out and they're back to potentially accumulating that subsidy debt again?
That's a really crucial point to ponder, the interplay between global markets and domestic policy. Knowledge is power, and knowing the context behind the headline numbers is what makes you truly well-informed. Use this knowledge wisely.